Good morning, everyone. Today, we're going to dive into what we call the Great Convergence, a fascinating intersection of macroeconomic fragility and an era of abundance. The global system is currently grappling with the monetary prisoner's dilemma, pushing us towards competitive devaluation and structural inflation. However, our core thesis is that generative AI and robotics are driving an unprecedented deflationary productivity frontier. In this new landscape, wealth preservation hinges on one critical factor: owning the means of production. This presentation outlines our investment strategy for 2026, designed to navigate these powerful forces. Let's start by understanding the monetary prisoner's dilemma. This matrix illustrates a critical challenge facing nations today. Imagine two countries, A and B. If country A maintains a stable currency while country B devalues, country A loses export competitiveness and experiences deflationary pain. Conversely, if country A devalues, it gains an export advantage, putting country B at a disadvantage. In a self-interested world, if one country devalues to boost exports, others are compelled to follow suit. The unfortunate outcome is a Nash equilibrium where both countries devalue, leading to a global race to the bottom. This results in synchronized inflation and negative real yields for currency holders, effectively eroding purchasing power worldwide. It's a negative-sum game for those holding cash, constantly fighting against the mechanism of devaluation. This brings us to the central bank trilemma, which explains why liquidity expansion has become a permanent fixture in our financial system. Central banks face a difficult choice between a small balance sheet, low-frequency intervention, and interest rate stability. Historically, to maintain stability, central banks have sacrificed a small balance sheet, leading to what we call the trap: scarce reserves causing repo market volatility. The choice to ensure stability means central banks must maintain ample reserves, effectively making quantitative easing a permanent tool. The risk here is significant moral hazard. The Bagehot rule of lending freely backstops private leverage with public money, creating a cycle that necessitates continuous liquidity injections. Now, let's explore the dollar smile paradox. This phenomenon describes how the US dollar's strength fluctuates across different global economic conditions. When there's global distress, we see a flight to safety and deleveraging, leading to a strong dollar. During periods of synchronized global growth, capital flows to emerging markets, weakening the dollar. And when the U.S. economy outperforms, driven by tech dominance and higher rates, the dollar strengthens again. Our data sidebar highlights a crucial point: the U.S., while representing about 25% of global GDP, accounts for roughly 50% of global debt, totaling $22.6 trillion. This structural short squeeze means the world needs dollars to service this debt, creating a floor for the currency. We anticipate the 2026 smirk, where U.S. outperformance, fueled by technology and high rates, continues to drive dollar strength. Moving to the productivity frontier, generative AI represents nothing short of a deflationary step change. McKinsey estimates its annual impact to be between $6.1 to $7.9 trillion. What makes this different from previous cycles, like the steam engine or early robotics, is the knowledge shift. Generative AI automates cognitive labor, impacting natural language tasks that represent about 25% of total work time. This is causing a significant timeline acceleration, pulling forward the automation of 50% of work activities by a decade, now projected for 2045. Our thesis is clear: technology, particularly generative AI, is the powerful deflationary counterforce to the monetary inflation we've discussed, fundamentally reshaping our economic landscape. Next, let's examine the robotics paradox and the turn. For years, we observed a paradox in manufacturing: productivity actually fell despite increased automation, as shown by a -3.7% decline in 2023. This was largely due to a skills gap and integration failures. The old reality was that automation didn't deliver the expected productivity gains. However, we are now at the turn. The new reality is that AI interfaces are bridging this skills gap. These natural language interfaces are unlocking the full capital efficiency of hardware. In robot hubs, defined as regions with more than 3 robots per 1,000 workers, The multiplier effect of AI is about to revolutionize productivity, starting in 2026 and beyond. This is a game changer for industrial automation. This brings us to labor versus capital, the great bifurcation. As technological progress accelerates, the cost of intelligence collapses. This has profound implications. For those who own the bots, the capital share of income and wealth is rapidly increasing. For those who are the bots, the labor share is decreasing. The key insight here is that in a digital economy, wealth concentrates in the means of production. This isn't just factories anymore, it's data, compute, and platforms. Our strategy, therefore, is crucial. The only effective hedge against labor displacement is equity ownership in the very platforms that are driving this technological revolution. A powerful confirmation of this trend comes from the TSMC signal. Hyperscalers, the massive cloud providers, are increasingly bypassing traditional supply chains to directly lock in manufacturing capacity. As TSMC management themselves stated, our customers are reaching out directly. Thus, our conviction in the multi-year AI megatrend remains strong. This is evident in their revenue breakdown, where high-performance computing and AI now account for a dominant 58%. The AI accelerator market is projected to grow at a compound annual growth rate in the mid to high 50% range through 2029. TSMC's capital expenditure for 2026 is projected to be between $52 and $56 billion, primarily for 2-nanometer capacity. This tells us where the smart money is going. This leads us directly to the CapEx moat. The combined 2026 capital expenditure for Microsoft, Amazon, Google, and Meta alone is projected to exceed $475 billion. This represents an unassailable barrier to entry for any new competitor. The infrastructure reality is that building foundational AI models demands tens of billions in data centers, GPUs, and energy. Furthermore, the semiconductor premium means only cash-rich hyperscalers can afford the 25% pricing premium for TSMC's cutting-edge 3-nanometers and 2-nanometers nodes. The conclusion is stark: startups must pay rent to these incumbents. This oligarchy is not accidental, it is structural, built on an unprecedented scale of capital investment that dwarfs venture funding. So, who comprises the new oligarchy in this AI value chain? We can categorize them into 4 key areas. In hardware, the engine driving everything, we have NVIDIA with their Blackwell GPUs, Broadcom with custom ASICs, and ASML with its EUV monopoly. For cloud, the infrastructure, Microsoft leads with Azure, Amazon with AWS, and Alphabet with TPUs and DeepMind. In edge interface, the distribution layer, we see Apple with 2 billion devices, Meta with the Llama ecosystem, and Palantir with its enterprise OS. Finally, in physical robotics, Tesla stands out with Optimus and its FSD neural nets. These companies, through their unique assets, form the backbone of the new AI economy. Now, let's look at strategic vehicles for achieving precision exposure to this new reality. We've analyzed several popular ETFs. QQQ, the Nasdaq 100, offers broad growth, high liquidity, and low cost, but it misclassifies tech by not including Amazon or Meta in its IT sector. VGT, the Information Technology ETF, is a pure tech play but also excludes Amazon and Meta. MAGS, representing the Magnificent Seven, offers a pure-play oligarchy exposure and high beta, but comes with excessive concentration, with 45% in the top 3 holdings, and zero diversification. Finally, BOTS, a robotics-themed ETF, is often dominated by NVIDIA, masquerading as a true robotics play. Each vehicle has its distinct advantages and disadvantages, requiring careful consideration based on your investment goals. Given the concentration risks, we make the case for equal weighting, specifically for the MAGS group. A standard index often suffers from single stock dependency, as shown in the pie chart where NVIDIA represents a disproportionately large portion. Our approach advocates for balanced exposure, where holdings are rebalanced quarterly to maintain relatively equal weight across companies like Tesla, Alphabet, Amazon, NVIDIA, Microsoft, Apple, and Meta. The logic behind this is simple: it mitigates the risk of a significant correction in any single momentum leader, such as NVIDIA, while still maintaining exposure to the broader platform thesis. The goal is to capture the secular trend of the entire group, not the idiosyncratic volatility of any individual stock. Another critical strategy is dollar cost averaging, which offers a clear mathematical advantage. As the harmonic mean formula illustrates, your average cost through DCA is mathematically lower than the average market price in volatile environments. We call this the volatility hack. Psychologically, DCA removes the timing error that plagues many investors. Indeed, 65% of funds underperform due to bad entry timing. In a high-growth sector like AI, our strategic imperative is clear. The primary risk is not volatility itself, but rather exclusion from the growth. Dollar cost averaging ensures your participation, allowing you to steadily build your position regardless of short-term price fluctuations. To summarize our investment thesis, we see the great convergence, driven by two powerful forces. On one hand, the macro reality involves structural debasement of currencies, permanent liquidity expansion, and persistent dollar dominance. On the other, the tech reality is defined by deflationary productivity breakthroughs from AI, unassailable capex moats built by incumbents, and significant value concentration in these new platforms. This leads us to the playbook. First, reject cash due to negative real yields. Second, own the platforms, which means gaining equity in the new means of production. And third, manage volatility through disciplined strategies like dollar cost averaging and equal weighting. In conclusion, our position is one of financial realpolitik. The gap between labor and capital is undeniably widening. As global alliances shift and reshape the dollar bloc, the safest harbor for your capital is no longer simply in currency, but firmly in the infrastructure that underpins the entire global economy. It's time to align your portfolios with this new era of abundance. Your strategy should be clear: own the oligarchy. Thank you.